Hello, everyone, and welcome back to the PetroNerds podcast. This is episode 106 of the PetroNerds podcast. My name is Trisha Curtis. I am the CEO of PetroNerds and the host of the PetroNerds podcast. Today is Thursday, April 18, 2024. This is going to be a nerdy, PetroNerdy, awesome roundhouse podcast where we're going to cover all the topical things happening in the market right now. And really, the three biggest things I would say today, as of right now, catching you up on previous podcasts that we've had is the state of the oil market, what oil prices are doing, what are the drivers. We'll talk a little bit about what's going on in the US, but we're going to dive into that in future podcasts. We're going to talk about inflation and the Fed because there's a whole lot going on right there. And we're going to talk about geopolitics and domestic politics. And sort of where is the green and energy transition, and where does this sort of stand right now? And I think we're having a bit of a checking game on that. And really, the geopolitics is so incredibly important because since we've spoken in the last couple of weeks, there's been a couple big things. The previous week, we had a hotter than expected inflation read. And within that inflation read were a lot of things, including higher electricity prices. But we also had an Iranian attack, a direct Iranian attack on Israel on April 13th over the course of the weekend. So that was really serious. And the consequences of that have sort of been being talked about throughout the week and really earlier part of this week. But there's a lot of mixed messaging and what's going on. So I want to unpack that a little bit. But we're going to start with, time stamping this podcast as we always do. We're going to look at WTI right now, West Texas Intermediate. Domestic crude oil prices are 82.59. Now, that should be a bit of a shocker considering that we did have this Iranian attack on Israel, and you would have thought, I absolutely thought that we were going to see oil prices spike higher, but that's not the case. And there's there's several different reasons for that, including the fact that we had crude oil inventories yesterday in the U.S. come in a little higher and actually build. So those weekly inventories, and as I've said before, I think traders are not fully appreciating and under appreciating all the fundamentals that are driving oil prices, including supply, including geopolitical risk, and including demand. Brent, though, is 86.93. So we've really seen that come off. So this is not a horrible price for crude oil. I mean, no one should be getting alarm bells in terms of oil prices going down, but in terms of where we're at from a geopolitical risk standpoint with multiple hot wars and a direct attack from Iran on Israel, that is pretty serious or is pretty interesting that we are not having as high oil prices, a $90 WTI or $90 Brent. So we're well under that $90 level. We saw north of $90 just a couple weeks ago, and now we're at under $87 for Brent. Dutch or Henry Hub is just an abysmal $1.74 right now. Incredibly low prices for natural gas. We're really seeing a lot of pressure on natural gas from the very, very high production volumes in the US and the very high storage volumes. So you've had a warmer than expected winter across the board in Europe and in the US, very high storage volumes in the US, and not just very high storage volumes in the US. We're having unprecedentedly high. So your volumes of storage are well above your 5-year average, and you see that. So you can see when you're looking at the charts on EIA, you can see a direct correlation. When those storage levels go up, the prices go down. And the problem is when you have 80 something dollar oil, you're drilling and producing for oil. We produce a lot of oil. And with that, you get this crap ton of associated gas. So no matter what you're going to do, you're not going to have a lower natural gas production, any meaningful lower natural gas production. Look at the natural gas production chart. It is just up. I mean, it's a straight upward trajectory. We're about 129 billion cubic feet per day of gross withdrawals in the U.S. That is the biggest reason why we see such low natural gas prices. And there are policies and politics around that. And I think it's really, really important because what we saw in the inflation read was higher than expected, was very high electricity prices of inflation for electricity, actually up 5%. That means that the pass through of this $1.74 natural gas is not getting passed along to the consumer. And I think that's really, really critical and important to think about. Now, we've got Dutch TTF at $9.77. If you look at the forward curve, you're looking at it's going north of $10, but it's still very low. It's still very low in comparison to what it was, at the peak where we saw, in 2022 when we saw $100 in MCF. But $10 is where it's hanging around, and that is because you're seeing a warmer than expected weather. You're seeing storage up. You are actually seeing LNG from Russia get into Europe. That is happening. You're seeing other product flows from Russia, from refined product get into Europe as well. And you're not hearing it talked about a lot, but you are seeing Norwegian gas flow into Germany, and you are seeing Norwegian gas actually and piped gas in Europe actually go not from Germany, but into Germany into other parts of Europe. So that's a huge thing. Now that being said, there's some serious issues going on within Ukraine itself. So the fact that in the beginning of this war in Ukraine, I was a little bit shocked that we weren't seeing direct attacks on, and we as many direct attacks on Ukrainian power generation and infrastructure and energy. We were seeing that, but now we're seeing that really escalated. And there's a couple different reasons why that's actually working right now, and that's partly because Israel or Ukraine does not have the defense capacity to knock out all these missiles or intercept them, and so the ones that are hitting are actually hitting, and they're impacting their infrastructure and their energy infrastructure. So, but that being said, we're going to switch gears. We're going to finish time stamping this, and we're getting into oil prices and inflation, the Fed, because there's a lot going on here. So the 10-year yield is at 4.637. That's high. We're pushing that 5% level for the 10-year yield. And remember that the 30-year mortgage rates are tied to the 10-year yield. There's a lot of things tied to the 10-year yield. It's the 2-year yield you can watch. I mean, you can watch all of these. But really important, I think, is that 10-year yield. The 30-year mortgage rate is basically right now on a, if you're Googling it, it's 7.5%. If you and I are to go to the bank right now, even with great mortgage, even with great credit scores, you are probably not going to get anything lower than 8%. So that means that the average person shouldn't be buying a home. 8% is absolutely ridiculous. And interestingly enough, we saw new home sales were down, not shocking, almost down 5%, but prices are up. And so if you actually look at that, if we're still seeing well north on average US home prices, well north of $500,000, you're still seeing the average chunk of mortgage well north of 400,000. And so you're seeing price cuts on the super high end. So you're seeing those price cuts on the super high end. Some price cuts you're hearing about them, but you're not really seeing things moving. And I talk about this, and you can drive around Denver. If you're driving around, you're looking at these homes that are north of a million. They've just been sitting there. They're not moving. And it is really interesting because it means that they're not these really wealthy people just coming in and buying cash offers in Denver for $1 million. So there's something going on there. But importantly, that high of mortgage rates and the stickiness of mortgages, partly why we saw these higher than expected inflation reads, which it wasn't the market, it was hotter than expected. Was not hotter than expected for anyone who has been going to the grocery store, who has been paying their electric bills, who is living in the day-to-day economy. That number was not a shocker. It was a shocker apparently for the Fed, and it was a shocker for the stock market, because the stock market and companies are hoping and betting for interest rate cuts. Interest rate cuts probably are not coming now. And we're finally seeing the Federal Reserve say that Jerome Powell said this week, he was at he was speaking with some Canadians in Washington on a panel, and he gave this readout and said, hey, the US inflation is not coming in lower than expected. They thought those two reads in January and February might have been a blip, might have been an anomaly, but this third read in March suggests that this is not, and we are having this respiking or this holding of inflation. Now, if you chart this, and I show this to clients and I give us some presentations all the time, but if you chart inflation and interest rates, there is a direct correlation. When we stopped raising interest rates, when the Fed stopped raising interest rates, inflation stopped going down. But it's just flat. It's a perfect direct correlation. Now, the other problem with that is that the Fed has been doing something where they're just talking very dovish. So they're saying, hey, we're not going to raise rates, we're not going to lower rates, and we'll just pause and we won't do anything. But every time we get out, we're going to talk really dovish. And that's what the market's baking in, is saying, or was baking in, saying, okay, it's going to get better, inflation's going to be fine. And you hear this reiterated throughout the stock market. You hear the CEO of UPS saying, oh, inflation's coming down and this is going to be better for everyone. You can't see it, believe it until you actually see it. So the problem is that when you had this bout of inflation that we had at 9% a couple years ago, and then it's slowly coming down, the pieces that are not slowly coming down are rents, our electricity, are these very, very sticky things. And now with this resurgence in geopolitical angst and all this volatility and these hot wars and this pressure and rise up in oil prices, you now have concerns with that. You are seeing gasoline prices actually tick up, but in the core inflation, which excludes food and energy, now food might be coming down a smidgen, but things that are included in core is rent. Things are excluded from the core, excluded for the food and energy. Energy would be one of those. But the problem is that rental prices are up, service prices are still up, and that and electricity prices are also up. And those electricity prices are the percentage increase is 5%. So month over month, we are, if you look at the March consumer price index inflation, you're seeing electricity prices up 5%. That's pretty high. That's well above that 2% level that everybody, that the Fed targets, and everyone, the European Central Bank, and every central bank is targeting 2%, but they're actually not getting there. So 5% for electricity. If you look at the actual electricity prices, you're seeing a really stark correlation upward. And that is in the past few years. This is not rocket science. This is two main factors, and that is utility companies passing on massive rate hikes as they shove these renewables into the grid, but it's also the cost of the renewables. There's a direct correlation. JP Morgan put this in their previous energy report. I have yet to read the new one, but I'm going to. But in their last year's energy report, there's a wonderful chart with a direct correlation of when you add wind and solar into grids in Europe, the electricity prices go up. And so we are at 17 cents per kilowatt hour. And that is a massive, massive jump in the past few years. So the problem with that is that's what you're hearing on the stock market right now. That's what you're hearing tons of companies talk about, from chip manufacturers. TSMC, the Taiwanese chip manufacturer. I mean, you're seeing every company is saying to make stuff, the cost of power generation, especially for the chip side, is huge. So the semiconductor, artificial intelligence, all those guys are talking about the demand for power generation. And we're going to get into that. I'm going to get into power generation shortly and how that folds into all this pricing. But I want to back up, and I want to go back up a little bit into the drivers for oil prices and what's setting the stage before we go back into inflation and the Fed and this rise in electricity prices, and get back into all this politics. So the big drivers in oil prices that we saw over the weekend, we did see Iran attack Israel with these missile and drone attacks. Now, almost all of them were intercepted. And so the UK and the US helped Israel, along with Israel, helped intercept almost all of these. A young woman, a child actually died. That is very sad, but not, the news and the media was sort of expecting that this to be a much bigger deal. Now, the reality is, if you're actually following this, and I was listening to or following all the stuff from the Institute for Study of War, the intention for Iran was not that these would fail. Now, it's being played off that, hey, this is a win for Iran and they're taking this as a win, and basically Israel shouldn't do anything. Of course, Israel's going to do something. They were attacked directly, and the reason this is such a big a deal is because this is a direct attack from Iran on Israel. And we have not seen direct attacks in this form. It's usually been through proxies, Hezbollah in the north in Jordan, the Houthis in the south in Yemen, and Hamas, which started this whole thing on October 7th when attacking Israel. So you have those three entities that are Iranian backed. Those are directly funded by Iran, but you haven't seen direct strikes from Iran on Israel. And this is in retaliation to Iran for Israel's strike on Iran that wasn't direct on Iran, but it was within Syria. It was a consulate. It killed several of their generals. It was a pretty big deal. This was a few weeks ago, and it killed several individuals. Now, there's all kinds of confusion on, was this a direct attack of an embassy? It wasn't. Apparently, it was a consulate building or next to it. So anyways, this was attacked. The response by Iran has been this attack over the past weekend. And then the big question marks earlier this week were, what is Israel's response going to be? And the reality is this puts the Biden administration in a pretty tight box. And it also means that the oil production out of Iran and how much they're exporting to China, and the fact that this is actually under sanctions, but the fact that we haven't enforced those sanctions is now coming into question. Okay, so you have the Israeli Israeli response, the ongoing Israeli response to the Hamas war from October 7th, and you have the Iranian response to the recent Israeli, what's perceived to be a ramping up of retaliation of a Israeli response on Iran in Syria. Now, this is the reason why this was such a big deal, and why it is so interesting that oil prices haven't risen significantly on the back of it, is because, and the reason the stock market and there's this angst and these concerns with inflation and oil prices is that the direct this is the first time we've ever seen Iran directly attack Israel. It's usually through these proxies. And so there is concern with that. But I think it's really, really important to point out that the intention by Iran was that these missiles did hit, right? It wasn't the intention that they didn't think that Israel was going to intercept all of these. Now, that does mean that Iran is going to go back to the drawing board and they're going to learn from this. And this does has implications and ramifications and learnings for Russia as well, because um, Iran is supplying Russia with drones and missiles. There's a lot of back and forth between Iran. Russia learns from this. Russia is attacking, heartily is attacking our Ukrainian infrastructure and Ukrainian power plants. And because Ukraine doesn't have all the capacity to intercept every drone attack, every missile, or every attack, because they can't intercept everything, the ones that do hit are having damage. So there is a sort of a numbers game here, and the fact that all these were intercepted in Israel is why this worked, right? Is why they didn't have a dent. And so Iran is really playing this off as the is a this is not a big deal, and that they won and they're using a diplomatic win, but they intended this to go further. So I think it'd be naive to expect that Iran wouldn't do this again, or that Iran didn't want to take it further. I mean, if you can only imagine if a handful more of those missiles actually hit, if the damage they had done something, if they'd killed more people, you would expect then an immediate Israeli retaliation, and this would have imploded and oil prices would have been higher. The risk is that now the risk and the impetus on that you're starting to hear, folks, even though it's not directly baked into oil prices and inflation, is that inflation is going up. Things within energy are driving up inflation, but also now this geopolitical risk premium. You're hearing Jamie Dimon talk about it in his letter that he had last week. Letter to shareholders where he talked about geopolitical risk. You're hearing geopolitical risk now being talked about more. This has been in the cards when we talk about crises, when we talk about economics, and I talk about this a lot, is that nothing's new, right? All these things have been happening. It's when they just come to the fore and they come to fruition and people start honing in on them. So when it comes to this geopolitical risk, is that it's all been happening. But when you have these a direct attack from Iran onto Israel, that elevates the game, and it means that Israel has to respond, and the reason they believe they have to respond is because this is a direct attack. So no matter what, they feel like they're going to have to respond, and they still want their hostages, right? They're still fighting this war, and you have a lot of folks that are angry about this because they're they're talking about the humanitarian crises. Google actually just fired employees that were protesting against Google for their work within Israel, and Google just fired their employees talking about genocide. Yeah, so it's actually a Wall Street Journal article, and it said Google fires 28 employees for protesting company's cloud deal with Israel. So Israel's a country that is a very tech, pre this war, which there's ongoing wars in Israel all the time, but it's a very tech savvy country. It's a very unique country in the Middle East, and it's a very thriving democracy and tech savvy country within the Middle East, which is very unique. And I don't like the relationship that Israel's had with China. I think that, they learned the hard way that China didn't have their back and was very pro Palestine. However, that being said, Israel has relationships with all these countries and companies. And so it's natural that Google would have this. But Google's response was that they were protesting and they were disrupting, and so they just fired these 20 employees, which I actually think for a tech company and the progressive world is pretty impressive. But there's a quote in this that said, quote, just as we don't want our work to be wielded in fossil fuel companies, again, relating to energy, just as we don't want our work to be wielded in fossil fuel companies, um, accelerate extraction and destruction. We don't want our work to be used in the service of military and surveillance products like Project Nimbus that continue this genocide. So these are, and this was posted, the group said in an X post, end quote. So that was a quote from the Wall Street Journal from this group. Now, so they're directly talking about, these are tech employees directly talking about, not wanting Google's involvement in Israel and calling this genocide. It's a very liberal term of the use, genocide, but the point is that this is an ongoing intensive problem. And now that there's been this focus on the Iranian attack on Israel, and now the potential Israeli attack on Iran, or retaliation, or their response to this, there's a lot of criticism that everybody's not thinking about and focusing on what's happening within Gaza. And if you're following and listening to Israeli podcasts and what's going on and listening to that, even though, and I've talked about this in previous podcasts, but even though there is a concern about Netanyahu, there's concern about the leadership, even though he might get ousted. The people are very much together in terms of their response to this October 7th attack, and how they and their response to Hamas, and how they feel as a country, and how they do want these hostages back. So the reason why you continue to see the stock market and you continue to see folks like Jamie Dimon and others talk about this elevated geopolitical risk is because this is an entrenched ongoing thing. That's why I highlight the Google thing. That's really serious. And energy is at the core of a lot of this in terms of not it's not the core of the war with Israel, and trying to get rid of Israel, but it's at the core of what's going on within the Middle East. And it is a big problem for the Biden administration with Iran, because Iran is producing north of 3 million barrels per day, is exporting probably around 2 million barrels per day to China. And so all the funding, billions, several $billion that they're getting each month from this money, from this should be sanctioned crude, that they're sending to China, probably a little bit to North Korea as well. China's probably getting a little bit of a discount on that, but they're basically the only buyer of Iranian's crude because it's sanctioned. No one else is buying it. And so Iran's getting this money, and Iran's therefore able to pay the Houthis and pay the Hamas and pay Hezbollah all this money. So, it's really unfortunate and unfair that people keep saying, well, Iran doesn't have a control. Whether you have control or not, you are funding these organizations. And so if you want to stop the funding, you need to say China's involvement in this is really serious, but you actually need to stop the crude flow out of Iran. And Obama was able to put these sanctions on countries because when the U.S. was rising rapidly in oil and gas production, we were able to do this, right? It was the first time in history that we were able to sort of wield this. And I'm not, you can argue whether or not sanctions and stuff work, but it was wielded as a weapon because the U.S. was able to produce more oil. We had more oil. We were adding to the global market. And so we could sanction countries and impact that oil production. Now we have sanctions imposed on Iran that the Biden administration has been trying to lift ever since they came into office. They've had a very dovish stance on Iran, and they've tried to have these deals brokered with Iran, but every time they try to do it, something bad happens, like October 7th. Now the Biden administration is flipping it and saying they're very hesitant to sanction, impact the crude because they don't want oil prices to go up any further. But they are now trying to increase what they were trying to do on October 6th, or right up to the October 7th attack, which is increase the rapprochement between Israel and Saudi Arabia, which is what the previous administration did. The Trump administration did the Abraham Accords, which was basically a acknowledgement and rapprochement, and it's sort of a peace deal and working deal between Israel and Arab countries, which is a big deal. And it's a platform to have better stabilization in the Middle East. So the fact that the Biden administration is going back to this and trying to broker this deal, it is very interesting that we are not seeing. We are hearing a lot of quietness, or hearing nothing from Saudi Arabia out of all this, given everything that's going on between Iran and Israel. China brokered that rapprochement, which I think is more fanfare than anything, but brokered that rapprochement between Iran and Saudi Arabia. Iran and Saudi Arabia are not natural friends. They don't get along. Now they are getting along collectively, maybe because of angst against the West, but I wouldn't bank on that as a real solid relationship. So Iran and Israel, or sorry, Saudi Arabia and Israel probably have a lot more in common in when they're on their views on Iran. Now, Saudi Arabia's willingness to do anything is a different story. Their comfortability, though, with oil prices going up, certainly they're comfortable with that. And you see that if you're looking at Saudi Arabian budgets and you're looking at what they're spending and what they want to do, everybody in the Middle East is comfortable with these oil prices. So no one's going to get too upset about this. And, coming back to oil prices and thinking about, what's the drivers on oil prices, if you're looking at actual production, if you're looking at production from Iran, so I don't think production from Iran has been curtailed. We were probably sending 2 million barrels a day to China. If you're looking at, China's taking over 2 million barrels a day from Russia. They're taking about 2 million barrels a day from Saudi Arabia. But if you're actually looking at these production volumes, and part of the reason that, we think about why are oil prices seeing these pressure despite this geopolitical angst, well, we had the dip in production in the U.S. From over 13 million barrels a day in December. We had 5 months in the U.S. of over 13 million barrels a day in 2023 at the back half of the year. And then in the January, the latest production figure that we have for the U.S. is under 13 million barrels a day. It's like 12.6 million barrels per day. That's probably a cold snap, winter weather. But now we have this lower rig count. Now, that being said, so we have January production. We're probably around 13 million barrels a day now, given what's going on within the market. But if you look at OPEC production, so it's important to think, okay, the U.S. is producing 13 million barrels a day. So we have 13% of production is basically coming from the US alone. But if you look at OPEC countries, if you just tally up what OPEC countries are producing, it's 27 million barrels per day. Excuse me, it's 26.6 million barrels per day is what OPEC countries are producing. Now, OPEC Plus, let's just add Russia to that. That's 10 million barrels per day. And if you look at the OPEC monthly out the figures, it's a little bit hilarious because if you go all the way back to what the OPEC agreement was, like the cuts that they keep extending, that agreement goes back to November of last year, November 2023. And the agreement says that they're going to, that we're going to have the extended lollipop cut from Saudi Arabia. So that keeps Saudi Arabia at 9 million barrels a day. And then Russia's going to cut 500,000 barrels a day. Well, guess what? Russia never cut that 500,000 barrels a day. And every month they say basically they're going to do it. And every month, if you look at the OPEC report, they revise production up for Russia. So Russia's producing just under or about 11 million barrels per day. So if you, or 10, so let's just add 27 million barrels per day plus 11 million barrels per day. You are well north of 30, you're at 38 million barrels per day. 39 million barrels per day and change. You're between 37 and 39 million barrels per day for OPEC plus output, just between OPEC and Russia. Now, and so Russia didn't do the cuts. Now, the reason they sort of said they were doing the cuts or alluding to it was because they were getting refineries attacked by drones from Ukraine. But the reason I point this out is because if you actually look at the cuts that OPEC said they were going to do, it's the fact that we're having these unique pressures on oil prices despite all this geopolitical angst is because they haven't materialized. The only country that's cut output is Saudi Arabia, and they're at 9 million barrels per day. We're at 13 million barrels per day. There's a gap of 4 million barrels per day between the former largest oil producer in the world and us, now the largest oil producer in the world, breaking records every month. We produce north of 13 million barrels a day. But right now, the OPEC Plus should be producing 35.99 million barrels per day. So they're not. They're, as we just said, they're producing about 37 million barrels per day, and probably even a little bit more than that, given other countries involved. So they're supposed to go down to, as of January, so we're past January, we're now into April, if people can recall. So they're supposed to be producing 34.32 million barrels per day. And then if you, even the further cuts that they said they were extending and adding in these last months, would go down to under 34 million barrels per day. So we're nowhere near that. So the point is that you are not hitting the targeted OPEC plus cuts. And that means that you have, for all the angst and everything, and the geopolitical volatility and the actual hot wars, we have spare capacity, which means that, Saudi Arabia could increase output if they wanted to. They're at 9 million barrels a day. They could add 2 million barrels a day pretty quickly, pretty easily. Russia isn't probably really holding back. I mean, if we asked Russia, if we can't really ask Russia now, or everybody's at war with them, or they're at war with Ukraine. But if Russia wanted to increase output a little bit, they probably technically could. Now, the refined product piece, they were getting attacked via drone strikes by Ukraine. I don't know if that's continuing ongoing, but it was not, I don't want to make light of this. It's not funny. War is not funny, but Ukraine has been attacking. Ukraine has been attacking Russian refinery infrastructure, and there was thought to be expected to be drop in output of refined product. We haven't really seen the crude materialize on that side. We'll see if it's actually materialized in the refined product output, a decrease. But the Biden administration went to Ukraine and asked them to stop doing that, and basically they just said, no, we're not going to stop doing that. But the problem is that Ukraine does not have enough weaponry to intercept and enough missiles and everything, which they're complaining about, especially in the context of Israel. Okay, so that's basically your context for oil prices from the Saudi, OPEC, Russia, and everything going on. If we think about the U.S., and like I said, we're going to go into U.S., we're going to dive into the U.S. a lot deeper in future podcasts. But if you look at U.S. production, we're under 13 million barrels a day for January. We had that drop in January. We're expected to, we're probably over north of 13 million barrels a day now. But we have a lot less rigs, and we are now at a new sort of low plateau where rigs have come off, but they've been at this point where they've just sort of flatlined for a while. And when you stare at that rig chart map, or the if you stare at the rig count chart, and I know people don't care about rigs anymore, but they are relevant because you keep going from these new lows. And it's always very, very impressive as to what the industry does with a lower rig count, especially when they get that established rig count lower. And it has had a material impact on activity. I mean, we see that in the US where you have less activity, you have a lot of uncertainty on the ground. If you're talking to service companies, it's a very, very mixed bag in terms of obviously natural gas prices being exceptionally low is certainly impacting the margins of oil companies. It's certainly impacting activity, and it's impacting every natural gas play, dry gas play, but it's also impacting, you're getting negative Waha, Permian natural gas prices. That's an impact. So for smaller producers and medium-sized producers, that really matters. Now, if you're in a gassier area, or a liquids rich area of a gassier play, that's working because your natural gas liquids prices are up because those correspond more to oil prices. So when you have $82 oil or $83 oil or $87 oil like we had only just over a week ago, and you have sub $2 gas, you're in a very, very unique environment for activity in the US. And that rig count, we need to see how many, the wells being brought online each month. Are our laterals continuing to grow? Are the length of the laterals continuing to grow? And are the well completions actually staying steady? And if that's the case, do not expect a massive drop in output in the US, more of a steady state. And that is even already, I'm sure, being interpreted by folks in the Middle East and folks abroad is that, okay, the US is tapped out, they're done. And I would be very, very careful with that because the rock, it's not about the rock. This is about activity, and this is about the leaders and the CEOs of these companies, how they perceive the market and how they're deciding to spend capital. I believe it is an absolute mistake to not be drilling a little bit more and increasing output at 80 something dollar oil and also hedging. If you can hedge at a strip price for the rest of the year, $80 a barrel, that is a really nice move. And if you are not making money $80 a barrel, we have a problem, because these companies, as you listen to the stock market and why they're saying, hey, buy into these oil companies, is because these companies are north of 70, should be making money hand over fist, and they are. And I think the margins and the returns and everything are pretty great. Gas margins are a problem, but we're going to have to be watching this space very closely. And I think it's super misunderstood and misanalyzed by the stock market, by folks following even oil pretty closely, and the trajectory and where we're going forward. That stock build in the U.S. does tell you something. I mean, it tells you that we didn't, we built up those stocks, but that's a 1 week thing. So when we are moving oil prices $5 swings or $6 or $7 swings in the span of a week or two, that's trading. So we now have, I mean, in the U.S., we have a total rig count of just over 600, according to Baker Hughes. So this has been flatlined for a while, and this is definitely going to be impacting, the state of how many wells we're bringing online each month. So, we have this flatlined rig count, we have oil prices that are ticking upward, and we're sort of, it's very fascinating if you're staring at this chart and you're actually looking at oil prices and the rig count, of the fact that we've had this materially higher oil prices and a significantly lower rig count. And that has a lot to do with to me, that does have a lot to do with the leadership in the space, with how these CEOs are viewing the market. I can tell you from my business as being basically a part of being in the service sector, how awful 2023 was and how horrible that is. And I can even tell you now, folks that desperately need market intelligence and can really see a value from it, they're reluctant to stroke a check. They're reluctant to lean in because they're saving money and they're cautious about the market. I think you should always be cautious about the market and you should be careful about the trajectory of oil prices. But north of $80 a barrel, we're not in a concern where we're going to drop off a cliff tomorrow. And we probably have floors, as I've talked about, on oil prices. And in the last podcast, when I was giving that presentation in November, and it was a month into the war, the Israel-Gaza war, and the attacks from Hamas into Israel, a month into that, we were only at $75 oil. And it was very, very fascinating to see that geopolitical risk wasn't baked in, and also seeing that the negativity and the angst on China demand was being baked in. So U.S. production matters a lot, and we're going to have to watch that space closely, and we're going to have to really, really watch this space with natural gas. So I think that's a good pivot here. I want to lean into this natural gas pricing because it's driving me bananas, the fact that we have natural gas pricing at sub $2 an MCF, and you are not seeing you're seeing utility companies make money hand over fist. You're seeing the CEO of Excel is their pay is over $20 million last year. The Biden administration seems to get very, very angry at oil companies when they make a lot of money, when the CEO makes a lot of money. And the Biden administration even writes letters to the CEOs of these oil companies saying, last year and when oil prices were high, that they need to pass along the savings onto the consumer. But we do not hear the Biden administration or any politician getting mad at the utility companies and saying, why are you not passing along the savings onto the consumer? We Part of the reason America is so prosperous, and part of the reason when you hear people talk about American energy security and why we are more insulated, we're less insulated now because the utility companies are not giving us the actual prices of natural gas. But we are insulated in the fact that, yes, oil prices go up and oil prices go down and we respond to that, but we're used to that. We're insulated because we have the supply. We have security of supply for oil, much more so than any country in the world because we produce more than any country in the world. But for natural gas, it is a constrained market, right? It's a regionally constrained market because even though we export 14 billion cubic feet per day of liquefied natural gas in a tanker, most of the natural gas we produce, that 129 billion cubic feet per day of gross withdrawals, is stuck here, which means that's why we have this price of $1.74. And so that should be in the utilities, given that that's half of our electricity, our power generation. Half of our power generation right now is coming from natural gas. So you should not be seeing a rising and rapid increase in prices in your utility bill. In anything, you should have deflation. So the fact that we have inflation and a 5% inflation for electricity is absolutely ridiculous. And people should be screaming from the rooftops. If you Google this and you look up rate hikes and all this stuff, what comes up is Colorado. It comes up as Excel because Excel is asking the Colorado Public Utilities Commission, which is a messy, horrible website to navigate. They're asking them for another rate hike on the consumer for natural gas prices for your natural gas rates because they want to put these renewables into the grid. And as I've already pointed out, when you're shoving wind and solar into the grid, and you can see that on EIA, right? They show you the wind and solar being added into the grid, and you can see where it's like, I think it's 60,000 megawatt hours. So it's considerable, right? So there is a correlation between the massive rise in wind and solar additions in the past few years and the massive rate increases we had in the past few years. And I've charted that, and you can see it. It's not just the wind and solar; it's the costs and the rate increases and the money and these hikes that are being passed along to the consumers, and the fact that these states and folks need to push back. But I do believe Excel has a cap of 20% natural gas in the electricity pool. They don't have a cap for coal. They're trying to decommission this coal, and part of that cost to the consumer is they're bearing the cost of these. They're bearing the cost of all this. They're decommissioning everything. So that's a huge issue. The reason it's also a real issue, and I've been talking about, is that rising cost of electricity is impacting the EV uptake. Right? People see the sticker price of the EV, but they're also calculating how much is it going to cost for me to plug that in. Lots of problems with EVs right now in the US, lack of infrastructure and cost of electricity. I mean, everyone's talking about hybrids. It's a more natural model. If you want something that doesn't have range anxiety and you want an electric vehicle, it's probably the hybrid. The reality is that, I mean, Tesla's way down this week. Tesla dropped their prices. They're having to compete with Chinese auto manufacturers. I mean, the onslaught we're seeing of Chinese exports from electric vehicles, lithium ion batteries, wind turbines, and solar exports are just massive. The rapid increase in the past few years have been absolutely considerable. There's a number of things going on with that, which we'll touch on in terms of China's sort of overcapacity and their dumping, which Janet Yellen was just over in China addressing, and you've heard more folks talk about that, including Biden trying to be tough on China. But that being said, is that the ability to have an EV uptake, it's already stalling. So it's stalling. Everybody thought it was going to be high oil prices, which were going to drive an EV uptake. Well, you have 80 something dollar oil, and we've had higher oil prices, and you haven't seen that. It's really the electricity prices and it's the cost of these vehicles. It's the resale. I mean, we saw Hertz actually lose their CEO. If you listen to the Hertz earnings calls, they were abysmal. They had to do a massive, massive write-off because Hertz, if you're renting a vehicle, even if you're on vacation, but especially if you're a business person, you're the last person you would really want to give an electric vehicle to because you're in a hurry and you don't want to spend time, charging up your electric vehicle the night before to make sure it has a charge, and finding the charging station, finding the ability to even find that. You can get a little bit of a charge, but then you have to, how long, it's hours to get that full charge. And so that's a really big problem. And I think America is not the place that you're going to see just massive, crazy EV adoption, especially with all these concerns, and absolutely with rising electricity prices. And that's even separate from the fact that we were talking about the demand for electricity, and so you can see that power generation in the U.S. has largely been flat. If you break out power generation, you can see I pointed this out many times, but China has over 5,000 terawatt hours of coal-fired power generation. We do not even have 1,000 terawatt hours of coal-fired power generation in the U.S., so it's a fraction of China's. So when we talk about CO2 emissions and we talk about global CO2 emissions, this is all for naught in the US. So when you are shutting down coal-fired power plants left, right, and center in the US, you are not meaningfully contributing to a decline in global CO2 emissions. You are just pushing that to China because you're asking them to produce things. And gets to this AI and manufacturing story. So the chip manufacturers who are making chips for artificial intelligence or supposed to be, and the fact that semiconductors and the Biden administration has put all this money, but now with a ton of stipulations, so the money hasn't really gone there fluidly. But to Intel and to other companies, you haven't seen these get off the ground nearly as quickly. But TSMC, the Taiwanese company, is talking about rising electricity prices. This is a big problem for chip companies, that when you make something, you need to keep your input costs low in order to be profitable. So especially even to be flexible. And you had like crazy high semiconductor prices and chip prices when we had COVID and things moving around and we didn't have enough autos, etc. But then you have a slump when things decline. And so now you have this NVIDIA going crazy. Now NVIDIA stock and ASML and all these stocks came off yesterday. And that was because ASML declined. And ASML is still, that's a Netherlands, or that's a European company, that they're still selling half their stuff to China, which they should not be. But the point is that you make the companies that are making things like chips, like semiconductors, like these things that we're thinking are going to build our future, artificial intelligence, anything that's making stuff or thinking or needs power, it's using a lot of power. And so it's not being done with wind and solar. I mean, it's just not. It's just that you don't see countries that make stuff with wind and solar. And partly that's because there's not a lot of honesty in the cost of wind and solar. So yes, China is dramatically subsidizing because they're using cheap to forced labor to make wind turbines and solar panels and lithium ion batteries and electric vehicles. All they're using very cheap coal, and they're further subsidizing that. So China just brought out a handful, probably more, but there was listed at least a handful of mothballed dead electric vehicle companies that they just pulled out of deadness to bring back online. You already know that they're not consuming these products at home. So we know that there's too much electric vehicles on the market now, and so they are dumping them. So there's a number of things at play there, why they're dumping them, what they're actually doing. Part of it's just keep their market steady, keep jobs and everything. But it's also, that has long-term impacts in terms of kneecapping Western manufacturers. But the point is that low cost, those low input costs, both from a labor standpoint and a coal-fired power generation standpoint, allow them to make things. And so if you want to be competitive in the manufacturing space for making products that you use every day, from an iPhone to anything else, you have to have power generation. And that's why it's so really important to think about what's going on in Ukraine, and the fact that Russia is saying out loud and articulating they are targeting Ukrainian power generation infrastructure because they want to hurt their ability and kneecap their ability to make weapons and defense capacity in the future. And this gets to a very critical point, which is you can't make ammunition. You can't make stuff easily and ready without power generation. So forget whether it's wind and solar. It's just, do you have it now? And we are very low on ammunition, right? We hear Ukraine saying, I want the same capacity that you're giving Israel to intercept all these missiles, but just ammunition in general, we are low in the world because we've sent so much to Ukraine and we have to rebuild this up. That takes money. That takes power generation. So we are at this critical juncture where we have to realize that you are going to need more natural gas in the grid. You are going to have to put, and you probably aren't going to be able to decommission coal-fired power plants, even if you wanted to. But more importantly, for the rest of the world, where you have the West trying to do this, right? You have Europe hell bent on decarbonizing and energy transition, come hell or high water. They're going to do that. The U.S. doesn't have to follow suit with that, right? We don't have to, and that's really important to raise the energy IQ and take a pause and have a sober moment in terms of, you have wars going on. You may want to do things, but you're not going to be able to. And the single greatest thing you can probably do rapidly decarbonize quickly, if that's what you truly want to do, is to add as much natural gas into your grid as possible. But you have other pressing things, which are like these wars, and you have to actually have ammunition. And you also, this comes back to sort of the peace through strength and not wanting to actually have a war. You have to have the ammunition stockpiles. I mean, I know people talk about the Strategic Petroleum Reserve, which I just want to talk about for a second. People always talk about the Strategic Petroleum Reserve as there's a debate. Do we need it? It doesn't matter whether you need it on a day-to-day basis. You have it in case you need it, and you do need it. I'm a big proponent of having a Strategic Petroleum Reserve because the point of it is that you don't need it, that you don't ever have to use it. But if you have to go to war, if you have to defend your country, you do not want to be reliant on anyone else for those imports. You want to have that here. And because we're producing 13 million barrels a day, and we would have an SPR if we ever refilled it after the Biden administration drained it, then it is a deterrent. It helps you prevent from actually having wars because you have the deterrent capacity and no one wants to mess with you. So just from the sheer national security standpoint, I do think it's really, really important to have your own SPR. We do need to refill it. I don't think the Biden administration is going to do that, but that's just a side note on SPR. Okay, so we've kind of went round the horn on electricity prices, brought this back to war in Ukraine, brought this back to manufacturing, making things. I'm going to go back to what's going on, and talked a little bit about China. Go back to a little bit of what's happening within the U.S. in a policy standpoint. But I just want to, I want to make sure we've beat the dead horse into the rise in electricity prices. That's something a very, very close space to watch, and it has really significant ramifications. I think when we're talking about elections and we're thinking about what does an election, Biden administration or Trump administration, mean for oil and natural gas prices? I know folks, they ask me, and I'm very candid about this, but folks get uncomfortable sometimes in the industry when you say, hey, Biden administration is obviously, I think, going to mean higher oil prices. And, natural gas prices, that's a question mark, probably lower natural gas prices because you can see the pressure on not having infrastructure. If you're not going to develop infrastructure and you have all this production on production growth in natural gas and you can't export it, you're going to have lower prices. That does not mean you're going to have a translation into your electricity prices. You're going to have continually rising electricity prices as you force these rate increases and you try to add these renewables too aggressively into the grid. A Trump administration would probably change that, right? We're going to have less regulation under Trump administration across the board, no matter what. If you talk to oil and gas producers, especially the smaller ones, you hear this in the Dallas Fed survey, the onerous regulations are really hard for them to deal with. That's across businesses. That's across every business in the country, from big to small. When they talk about the single biggest things impacting their business, it's regulations and regulations in the US. And that is a big, big deal. So red tape is a big deal. You see this when people talk about Germany, you see this from German farmers, but really in the US, we are at a breaking point now where we have so many onerous regulations. And so I think very simplistically, a Trump administration is going to mean less regulations, more open to business. That bodes well for natural gas prices. And in terms of, are we going to build up any kind of infrastructure? Are we going to allow for increased exports? If that's the case, we could see slightly higher natural gas prices. But with slightly higher natural gas prices means more activity on natural gas. So that's probably going to wait itself out. When I say lower oil prices, probably if you say yes to Keystone XL, if you build out infrastructure, if you give a green light to oil and gas producers, or you just say oil and gas producers, we're no longer at war with you and we're not anti domestic oil and gas production in America anymore, you're going to probably increase oil and gas production, especially from the smaller private companies that need they need that, right? They don't have teams of lawyers and they can't go to Washington every day and lobby on this. They need that actual assurance, and they will be drilling and producing, and they will respond to a more certain regulatory environment, especially if we're north of $60 oil. I think you'll see those operators go back to work. So any kind of infrastructure development, and I think that's very important to watch in the political space. And I think it is really, really important to think about a couple things. And that's that last night, there was an article that came out from Bloomberg that said, and it's quote, White House renews internal talks on invoking climate emergency. Now, if you talk to Tad True, who's been on the podcast, and a friend and colleague of mine, he'll say he's an eternal optimist and this wouldn't happen. Probably. Like the Biden administration probably is not going to invoke a climate emergency and reduce output and, ban drilling and all these things. However, because that would be horrible for oil prices and gas prices and therefore his ability to be reelected. However, the reason this is a headline is because they have talked about this and they are being pushed by the younger electorate and the big green advocacy and push to actually do this, to further ban LNG exports, to ban drilling, to really curtail the output of domestic oil and gas production. So this is really, really serious. And this is something that they're talking about this. And I think you have this, you see this within White House policy on China. You see this within, I think the policy on energy is abysmal, but you see a lot of flippancy on China. You see a lot of flippancy within it when it comes to the Middle East, where they don't really know where they're at. And energy is at the core of all of this. I'm simplifying it, but it really is. Energy is at the core of what we're dealing with China. Energy is at the core of what we're dealing with the Middle East. And the Biden administration is so anti-domestic energy that they have a problem with this. So headlines like this are really, really big deal. And the fact that they're even having a conversation about it it's so deplorable and it's so wrong and it's so sad that they're not willing to stand up and just say, hey, we understand what you want, young people, but the reality is we have to produce energy, and we have to produce low cost, reliable energy for the very people that you say that we need to help, which is the low income consumer. So I'll just read this. It says, quote, White House advisors are divided over the idea of declaring a climate emergency, with some saying it wouldn't provide Biden enough newfound power, newfound authority to make substantial changes, the people said. Others, however, argue such an announcement would galvanize climate-minded voters, hence why they're trying to do it, or why they're thinking about it. So, resuming quote, officials have not made a decision on the matter, nor is any declaration imminent, the people said. White House discussions over potential policy steps can span years, sometimes ever coming to fruition. Okay, the point is that it's being talked about. That was leaked by Bloomberg. And then I think this is really important because, the industry knows that I've been, and folks in the industry listen to this podcast, they know that I give credit where credit is due. I like that Darren Woods and Exxon, and I like the stat, a more of a pushback, especially from the actually having lawsuits against these climate activists and the shareholder pressure. I think that's very positive. The reason I think this is so important to have very good leadership and clarity, especially from publicly traded companies, is that information disseminates through the market, right? It's how people actually get intel. So when, it's really important for voices like mine to be out there, to be talking to the market, to be giving clarity and giving a different view, that you're not getting this granular energy intel from the stock market because they have kind of a bias and because they just don't know. But also you have to have some semblance of reality. And so that's why it's so important for the CEO of Exxon, that, why Chris Wright, when he says what he does, that you have to have that information because it does disseminate through the market. Chris Wright inevitably gets on TV and he gets to talk. He was just on Last Call with Brian O'Sullivan, and it was hilarious because Brian O'Sullivan is asking him about renewables and stuff, and Chris Wright says, wind and solar comes from China and it's made from coal. And Brian thinks he's a genius for saying this, which, Chris Wright is a very, very intelligent man. But this should be common knowledge, folks, that the onshore wind turbines are made from coal and free to forced labor coming from China, as is solar panels, right? You cannot make solar panels without, they come from the province of Xinjiang and they come from China. Okay, sorry, but tangent before we wrap this up. Okay, so big oil companies, this is a quote from, this is Wall Street Journal. Big oil companies warm to Biden after years of bad blood. Now, I don't think big oil companies should be warming to Biden, and unless they're going to actually, the Biden administration is going to come out and say, we're done with the war and we're going to do business with you. Because I think that, you can get into the stance where you don't actually have clear, articulate policies. And the oil and gas companies need to be very clear and articulate to what they're doing, how they're investing, and why folks should be buying their stock. I'm not a fan, as I've said, about share buybacks. I don't think that is giving the market the right message that they should be buying your stock. And I think that now we're having a resurgence in folks sort of a recatalyzing in energy, thinking about a hedge being on inflation. And so people are investing in energy differently. But I think that the oil companies have to be very, very cognizant of how they're talking about this, how they're talking to the street, and they need to be leading. It's really, really important now that the energy industry, the oil and gas industry now has to understand electricity, now has to understand what this means for power generation, and the fact that they need to be in this power generation space, and they can't be letting utility companies just walk all over them. So with that, folks, I think that's my rant for the day. Industry leaders need to lead. I am, as you can tell, I am super passionate about this business. I love it a great deal, and I care about the market intelligence in this space. So if you think this podcast is awesome, and you want this market intelligence out there, you should come reach out to PetroNerds. Would love to have you sponsor the podcast. Would love to get folks on the podcast. I have a string of guests lined up, so we will have more guests coming on the podcast. And reach out to PetroNerds and become a client of PetroNerds as well. This is the year to be a PetroNerd. We have more geopolitical volatility, more angst in that I've seen in a very, very long time. So it's time to get PetroNerdy with PetroNerds, folks. Talk to you soon. Bye.